What's up, guys? Hope you guys are doing good. Welcome to the video. Alright, so we have a lot to go through this video. I actually just got done making the PDF for this. So pretty much what we're going to be doing is going through indicators, a couple indicator strategies. We're going to be going through some candlesticks. I'm going to be explaining the candlesticks. I'm going to be explaining two types, just normal candlesticks, which you can see right here, and then the Heikin-Ashi. I'm going to be explaining the stochastic RSI, the normal RSI, and then the MACD indicator. So I'm going to be explaining all those, and then I'm showing you how to use the strategy with it. I'm also going to be explaining moving averages, EMAs and SMAs, exponential moving averages, and then simple moving averages. So we got a lot to go through today. And then before we get into this video, just want to make a disclaimer. Whatever you do with your trading is on you, it's not on me. I'm just sharing my personal experience, things that I wish I knew when I first started, and how I improved it over time, and made things better as I got better as a trader. So whatever you do with your trading, that's on you, that's not on me. Alright guys, I love you guys. Let's jump right into it. Alright. So, first thing we're going to do is I'm going to get into this PDF. So you guys can be able to download this PDF. I'm going to make it so you download it. There's a lot of good information in here. There's some resources too. I actually forgot to put some resources for the candles. So after this I'm going to put them in, and yeah, so you could read that. I would absolutely recommend clicking these links right here and reading these articles. Investopedia, it's good stuff. It'll teach you everything you know. Oh yeah, also happy St. Patty's Day. Okay, so Japanese candlesticks. So we're going to talk about Japanese candlesticks, either like the OG of candles, way better than the bar charts. Bar charts were created in the US, but the Japanese came out with the Japanese candlesticks and just blew the bar charts out of water. We're more accurate. So there's a couple things you need to know about the Japanese candlesticks. So let's get into the Japanese candlesticks. Alright, so these this white body in the middle is the body, and then the black body in the middle, that's the body. So this is where this candlestick opened, and this is where it closed. So this would have actually been a red candle. When people study candlesticks, a lot of people will have them in black and white instead of red and green. So white would be the green, and the black would be the red. So this is where it opened, and then the price dropped, and this is where it closed. This is the highest the price has ever been, and this is the lowest the price has ever been. Alright? And then this is where the candle opened, so this would have been a green candle over here. So it opened up here at this price, and then the price went up and it closed. Okay? This is the highest it's ever been, and this is the lowest it's ever been. Alright? So these are your typical candlesticks. I'll show you what they look like right here. Let me zoom into one. Alright, so this is the highest the price has ever been on this candle. This is the lowest the price has ever been on this candle. This is where the candle opened, and this is where the candle closed. Alright, so right here, this is the highest this candle's ever been. This is the lowest this candle's ever been. This is where your candle opened, and this is where your candle closed. Alright, and then that's how you read typical candlesticks. There's a lot more to it, and I'm going to make more videos on this in the future. Alright, because there's so much to candlesticks, it's ridiculous. Alright, and then the candles that I'm going to recommend using, or that I use myself and I prefer to use, I started with normal candlesticks, but now I use the Heikin-Ashi candles. Alright, and we're going to actually turn that on, because that's going to be part of the strategy, is using the Heikin-Ashi. So you click right here, and boom, you slap the Heikin-Ashi on. And also, we're going to turn this volume off. So you just click on the volume on the bottom, exit. We don't need that right now. Okay, now we have the Heikin-Ashi candles. And we're going to get into the Heikin-Ashi right now. So yep, this is what they look like. That's what we have. Heikin-Ashi candles are calculated from using information from the previous candle. Alright, so the information from this candle is used to calculate what's going on in this candle. Alright, same with this. The information in this candle is used to calculate the information on this candle. And you will also notice, I didn't put this down in the notes, You see how it has all the wicks on the bottom, and then the uptrend has all the wicks on the top generally? That is just because of how the Heikin-Ashi is calculated. Because the normal candlesticks are only calculated by the open, close, low, and high of the price, alright? The Heikin-Ashi is calculated with like medium and averages, which we're about to go into right now. So the open of a Heikin-Ashi candle is calculated by taking the average of the open and close price of the previous candle. As you can see, the previous candle opens at 50% of the previous candle's body. Alright, so it'd be the average. So it'd be this price and this price. It'd be the average of that, which would create the opening for this candle. Alright, and you see it's always 50%, top 50%, top 50%, top 50%, top 50%, top 50%, top 50%. Okay, you get it. The close is calculated by taking the average of the high, low, open, and close of the current period. Alright, so this would be the current period, or this would be the current period, sorry. So the high, the open, the low, and the close would be calculated, and you would get the average, and then that is how you get where the candle closes. Remember, open, close, open, close, okay? See where we, the close is calculated, yeah, we did that one. The high is calculated by taking the high, open, close of the current period and choosing the maximum out of the three. Okay, so high, open, actually high, open, close, and then you're going to take the maximum out of those three values to get it. This is stuff you really don't want to know. You don't need to know, but I feel like explaining it, the more you know, the better of a trader you're going to be. Okay, so I'm just going to explain it. I want to make this very informative for you guys. The close is calculated by taking the low minimum close of the current period and choosing the minimum. So same exact thing, low, minimum, close. And then you calculate it, and then you choose the highest out of the three, and that's how you get the low. Alright, and then Heikin-Ashi candles are used to smooth out price action, eliminate noise, making it much easier to identify the trends in the market. So you can see the trends are pretty much just green and red. Alright, but if we go back to the normal candles, it's messy, it's noisy, it's noisy, it's kind of sloppy. Alright, so the Heikin-Ashi candles just make it a lot more simple, a lot more easier. Alright, so yeah, that is the candles explained really fast. Right, now we're going to get into the RSI, the relative strength index. Alright, so how we're going to slap this onto it, we're going to click the indicators button right here, type in RS. Alright, okay, you're not going to click strategy, you're going to click relative strength index. Alright, so there's a couple things we need to get into. We're going to go back to the PDF real quick though. RSI is a momentum indicator used in technical analysis that evaluates recent price changes and determined overbought and oversold conditions. Alright, the RSI was introduced in 1978. If the price is over 70, the asset you're invested in is overbought. If it's below 30, it is oversold. Alright, so I'm going to go right here, 70 line, so everything over here is overbought. So it's pretty much saying that a lot of people are buying it. It is due for a correction. You know, it's like a rubber band. You stretch it out, and once it pulls itself back together. All right. So when it's over the 70 line, it is overstretched. It's trying to pull itself back together. And it is the same thing over here with this 30 line. This means it is oversold. So a lot of people are selling it, and it wants to pull itself back to that center medium. It's trying to pull itself back into this room. The middle frame right here. Alright, let's see what else we got. Alright, and then this is a tip that I don't think Investopedia actually says it on it, but this is a very, very good tip to have. I highly recommend putting a 50 line on your RSI. It shows when the trend is in an uptrend or a downtrend. When the RSI is above 50, it's in an uptrend. When the RSI is below 50, it's in a downtrend. Alright, so I'm going to show you how to do this real quick. So we're going to get a horizontal line. We are going to find 50. Come on. Yeah, it's not the best, but it will work. and then make that chunky. Alright, so that's our 50 line. Now I'm going to show you what I mean. So you see when it goes below this 50 line, you're starting to tank. Your price is just going into a downtrend. It's downtrending, and then when it's up, the trend's going up. Okay, so let me get my pen to show you. Right here, we're going down. Alright, and then right here, we're going up. Right here, we're going down. As soon as we break it back above it, right here, we're trending up. Alright, the thing you want to keep your eye on. So you want to keep your eye on the oversold and overbought territories. You want to place your trades generally when it's below this 30 line. That's a really good position to say, hey, let's get in. And you definitely want to sell when it's above this 70 line. And then you use this center line to say, is the trend going up or is our trend going down? Alright. And you can also just look at the candles. If it's going down, it's obviously going down. If it's going up, it's obviously going up. Alright. So that is the RSI. Pretty simple. It's just used for momentum, to telling which way the trend is going. You don't particularly make trades off of it itself. Alright. And then we're going to slap another indicator on here, which is going to be the Stochastic Star RSI. Alright, so the Stochastic Star RSI, you don't have to do anything to. You just go to Stochastic RSI. Alright, slap that bad boy on there. Boom. Alright, now we have our RSI and our Stochastic RSI. So this is the first strategy. You do not have to add anything to this to use the strategy. All you need is those two indicators. So the Stochastic RSI was created in 1994 to distinguish market trends. So saying, like, you know, we go like, we have right here, we have the crossing, it's an uptrend, you know. And we go, you know, we have here, it's a downtrend. So it is distinguishing the trends in the market. This is more of a distinguisher. I would say this is more accurate. This is more for like getting opens and sells. But if you have both of them going in the same direction, like this is going up and this is going up and this is above the 50 line, you can absolutely tell that is an uptrend. And you can do the same thing, like right here we're down, right here we're going down. You can tell that we're in a downtrend. Alright, so that's really good stuff to know. This 50 line, it's a game changer, like if you look at it. But yeah, this Stochastic Star RSI is for your buys and your sells, and this is just to tell your trend. Alright, let's see, it's created. The Stochastic was created to improve upon the original RSI indicator. The Stochastic RSI is a normal RSI, except the Stochastic RSI has the stochastic oscillator formula added to it, hence its name. Alright, I would show you the formula. It is very confusing. You don't need to know it. If you're a math genius and you want to know it, go ahead, but it hurts my brain to look at it. I'm bad at math. But yeah, that's that. You just click the link, it'll be in there. The main thing you need to understand about the Stochastic RSI has three important values to look at. It has a 0, which is all the way down here. This means it is oversold. Alright, oversold is where you want to take your buy inventories. And then we have the overbought up here. So we have the 20, we have the 80, and then you're going to have the 50. You don't have a 50 line on here. You could always slap a 50 line on if you want to, which I would recommend do. Just boom, pretty close, 50 line. Alright, and the stochastics will have values between 1 and 10 and 1 and 100. Alright, it doesn't really make a difference which one is which. This is 1 to 100. Most will be 1 to 100 now, but you can find some that are 1 to 10. If the value is more than 80, it's overbought. This means many people are buying and the price is due for correction. If it's below 20, that means not enough people are buying and the price is ready to go up. Alright, so we have our 50 line, we have our center line. It doesn't exactly like tell you the trend on this. It's generally just buy and sell signals. But I'm going to do some back testing with this real quick. I'll show you what's going on. Alright. So right here, we are oversold. we are below the 20 line, all right? Right here, we are pretty much oversold. We're below the 50 line, so you can tell that we are in a downtrend, or a bottom of a downtrend. But right here we have the cross where the blue crosses the orange line, which is a buy signal, and then we have oversold, or the bottom of a downtrend right here. All right, and then you get to see we have the trend that went down. So you wouldn't see any of these green candles there. You wouldn't see any of them at all. And you would wait to have this right here, this cross, and you'd wait for your RSI momentum to start to go back up. And then you would wait for your first green candle to print. You do not want to have these signals to buy and buy on a red candle, because the price might not go up. It could very well just go back down and you will lose your trade. So you always want to wait for confirmation. So you can see we have right here, we have the buy signal here. We have the indication that we're going back up in momentum, and then we see our first green candle, and then we take a long. Boom. Okay, now how would you sell out of this? You know, we're riding it up, we're riding, and you want to get out. Alright, so you would look for your sell signal on your stochastic RSI, which we have our first cross right here, alright? Which would be here. So you would wait for this candle to print, and then you would see that our trend is starting to go down, alright? And that's when you would get out. So I would take the trade from here, ride it all the way up to here, and then I would have the sub confirmation. You can see right here it go down. You wouldn't realize it's going up yet, so you might miss just a little bit of profit, but you're safe. You took your profits, you made your gain. Who cares about this extra little bit of percent? Who cares? You can see it started to take down, and you would sell right there. All right. This is a very easy and simple strategy. All right. Shoot, I took my 50 line off. 1 second. All right, and now we are going to make this strategy even better. So there's a couple things you can do. I'm actually going to do one of them right now. You go to indicators. So you just type in 21-day moving average. Alright, moving average. Sometimes you gotta play around with it. 21, defined it. Okay, the 8 to 13, 21. Boom. Alright. Now this will make this strategy even better. And I'm actually going to go into a little bit about moving averages right now, because you need to learn about moving averages when you get into the next strategy with the MACD. Right here, moving averages. Alright, what is a moving average? A moving average represents the average value of previous data during a predefined period. Alright, so it takes previous data and it just pretty much makes it into a line. There are two types of moving averages: the SMA, the simple moving average. The SMA assigns equal weight to all previous data, so all the data is equal, so it's linear. And then we have the EMA, the exponential moving averages. The EMA assigns the more importance of the most recent data values. So it uses the more important data, and then it is exponential off of that. All right. And right here we just have the this is the EMA, the exponential moving averages. So how will make this strategy even more beefy and even more better? As you can see right here, we have overbought. Right here, you can tell we're overbought because we are over the 70 line, right? All right, and then we have the cross down right here. We are overbought as well, so we have two confirmations right here. Overbought on the RSI, overbought on the Stochastics RSI. All right, and you see that our trend is going down. All right, which is a good sign. And then we look at our candle. You remember, you always want to wait for the first candle to print and the first candle to close. Alright, so we went all the way down to here, but we pulled back up. That means the bulls were having some fighting power. They're trying to fight back. But we closed below the 8 and the 13. Alright, and we just held. So that is saying that like we're losing support, you know, we're not holding as strong as we used to. And that is a very good confirmation. When you are below, that is a very good confirmation to buy. That means you are losing support. That means the bears are winning. Once you start to grab and start holding on these lines again, that is a good signal to buy again. So if you're falling through these lines, that is a good signal to say, let's short, let's go, you know, let's short. But if we're starting to hold and we have like momentum on these lines, like right here, look at this, boom, boom. We bounce right off here, off this 50 line. Right here with a good buy signal. And this is saying, hey, we're bouncing off the 50 line. So we are staying in positive upward momentum. And this whole time, all the way up to here, we are up above this line, which is really good. And then we are holding above our 18, our 13, and our 21, and we just ride it up. But if I were to do this trade, what I would do, I would buy here, I would look at this, I would wait for the confirmation on the first candle, make sure the first candle goes from red to green, and I would long it all the way up to here, alright? And then right here, I have confirmation that we're going down, alright? And you can see right here, it would break right above here. It means we're starting to lose momentum because we're going down. And I would have sold here. And then I would have waited. I would have probably bought right back in up here. We start going back up. I would have waited for the confirmation on the first candle right here. Boom, broke right above the 8-day. Held support, gone up here. And then I would have sold right here. That shows that our momentum's going back down again. Alright. So that's how you use this strategy and make it even more accurate and make sure your chances of winning are even higher with the moving averages. Alright. We are going to take this and throw it away though, because we are going to get into the MACD now. So let's get the MACD. Alright, so this is our MACD. We're going to have to do some changes to this indicator as well. Alright. This one is the most complex indicator to explain. It's pretty complex, but it is a very good indicator mixed with the Stochastics RSI. The MACD and the Stochastics go hand in hand, and it gives you very, very strong buy signals and sell signals. So, MACD, Moving Average Convergence Divergence. It is developed in 1970. The MACD uses moving averages to determine the momentum of the average. So, right here, you'll see it says the MACD, the 12-period EMA minus the 26-period is how you get this first blue line, alright? So, it's two averages subtracted each other, and that is how you get this first line, alright? And then we have the MACD signal line, which is the 9-period EMA of the MACD, alright? So it is the 9-period EMA of this line, and that is how you get this red line right here, alright? And then we have the histogram, which is this line subtracted by this line, and you get a histogram. So generally, it's a line. You can make it a line if you want to, or you can leave it as a histogram. I personally like the histograms more, but it's just this line minus this line, and you get your histogram, alright? So the MACD indicator is calculated by subtracting two EMA exponential moving averages to create the main MACD line. So X day EMA minus X day EMA, which would just be whatever day it is, which would be the fill in with X's, and that is determined upward or downward momentum. Alright, like you don't need to do these mathematical equations, you really don't need to know them, but it's good to know. If you want to be, a trader, and you want to be experienced, and you want to know your stuff, then yeah, it's good to know. You don't need to know it though, right? The main MACD line is then used to create the signal line. So once you have your first line, your MACD line, you get your signal line, which would have been the 9-day moving average. Okay, and then the histogram, the MACD also has a histogram, which is the difference between the MACD and the signal line. The MACD minus the signal line equals the histogram. Okay, the histogram line is calculated between MACD and the signal line. The correlation between the two lines can be known as convergent or divergent. Convergent is when the lines are close together. Divergent is when the lines are further away from each other. Okay, so when they're close, they're convergent. Okay, they're converging into one. They're getting closer. All right, and then when the mouth opens up, that means they're diverging. They're getting further away. All right. So converging, diverging. All right. You could also use it to figure out bullish divergence, bearish divergence. I'll get into another video, but it's something very important to know. Same thing with candlesticks. Very important to know. All right. And then we do a little bit of editing on our MACD, and then we are going to backtest this a couple times. Settings to 821 and 5. All right, I just added this real quick. I didn't add it earlier, but it is very important. So you go to your MACD, you click on settings. So your fast length, 8. Your slow length, 21. And then your signal smoothing, you slap that into 5. All right, and then click OK. All right. Now we have everything set up for this beautiful strategy. Oh, I gotta stretch. Okay, for this beautiful strategy. So, for confirmations, we always start with whatever's at our bottom is what I like to start with. So we have a cross right here. All right. So there's a couple things about the MACD you want to know before you make a trade on it. You want to wait for your histogram to go from red to green. Alright, when you go to red to green, you have that confirmation. And then you want to look for the cross where the blue line crosses orange. So blue crosses orange, and then we have our first candle. Boom, confirmation. Alright, we have the first confirmation. And yeah, look, we did have confirmation right here on our side. You could have taken it right here. But, it might have been like a fake signal. It might have been gone up, gone straight down, or just gone straight down. You always want to stick to your strategy. So just play around with this and back test and just figure out what works best for you. But this is what works best for me. Alright, so we have a confirmation. And then you can see we have the confirmation right here as well. So I would have took this confirmation and be like, alright, we got confirmation on our side. But I would have waited to have the confirmation on the MACD, and then I would have placed my trade. And then the momentum is going up here. You see right here, we have a sell signal, but we also have a sell signal right here. All right, so you could just take advantage of this sell signal right here and get out, or you could wait until this turns red to get out. All right, if you bought right here, you would have gone in right around here, and it would have gone. Oops, 1 second. You would have bought in right here, and it would have gone up to sold right up here. So, come on. You would have made 11. You would have made 9%. 9% off this trade. So if you're trading with 10x leverage, $1,000 as 100%, you're turning that $1,000 into $2,000. Easy as that. All right. This is the dollar trade, or the 1-day chart. So yeah, that right there is a very strong trade. You would have made a killing off that. Sure, it would have taken, what, 1, 2, 3, 4, 5, 6, 7, 8, 9, 8 or 9 days. But still, 8 or 9 days for $1,000. That's $3,000 a month, You could also take the short trade. Right here we have confirmation, we're oversold. We have the confirmation right here that we're going down. We go from green to red, and we have our confirmation on our MACD. Look at that. Beautiful. Textbook, beautiful signal, alright? Like, you are not going wrong with this. And boom. Alright? Let's see how much you would have made if you got into this trade. 27%. That would have been 270% with 10x leverage with $1,000 that would have been $2,700 in profit, alright? Which is insane. This strategy, I'm telling you, for a free, cheap strategy, with all the information provided you, it is killer. So this would have been 1, 2, 3, 4, 5, 6, 7 days to make 2.7 grand with only 1,000 invested. Smart trading, you waited for the confirmations, and you just took your time and you went with what you went with the flow. You saw RSI is going down, boom, momentum is going down. You got it go down. It goes over the 50 line. Beautiful, beautiful. All right, we have the confirmation right here that we're going down, and then up here, we're oversold, we're overbought, we're in overbought zone. So that's perfect. That's saying right there we're gonna go down. And then we have the cross right here, where we went from green to red, and then we have the 2 lines across. Boom, textbook, beautiful. All right. So we showed you that one. That one's killer. All right. You could long this whole trend right here. I will get into that later, of how that is possible and how that do when you get into exchanges, when you get into stop loss limits, stuff like that. This is a little bit of a different strategy. You could use the same strategy, but you have to add more to it when you get into your brokerage or exchange to be able to get this whole trend. This whole, I don't even know what it is, 280% or 230% in like 2 months. All right, let's say 60 days. Yeah, 2 months. But we'll go into the basics. So what I would have done, I would have gotten right here. We have the red going into the green right here. Boom, you have your cross right here. All right, you have a cross right here. Perfect buy signal. We're bouncing off this line right here. We don't go under, so it is still saying we're in a trend. All right, it's all right. You could wait. You could wait a day or two if you have to. Wait for it to have confirmation to hit this line and bounce up. Because if it hits this line and you buy in and it doesn't bounce up, it could go down. So instead of the price going like this, your price is going to go like that, and you're going to get screwed. Alright, and then you get your sell signal right here. Boom, boom, green goes into red, crossing down. Alright, and then let's see what percent we would have got here, right? 125% in 19 days. Alright, so you get the point. God, that's like 10,000. Like 10 grand. If you invested 1,000 with 10x leverage. Your fees would be pretty high though, so you wouldn't make like 9 grand. But the point is that this strategy works. We are back testing it and we are proving that it works. All right. So this is a beautiful, beautiful strategy if you don't want to buy any indicators. And yeah, if you don't want to buy any indicators, this is a perfect strategy for you to use. The strategy I actually use indicators for that I bought. But it's like your basic, easy, like no fail, to go-to strategy. You just want to make sure you have your 50 lines added on this, and you want to make sure you have your 18, 21, and 5. All right. Oh shoot! I realized I just screwed up. You want it to be 8, 21, and 5. All right. Well, that makes things a little bit different. So I realized that I screwed up. You want to have this 821.5, not 1821.5. That was my bad on the typo. But you can still see that it worked, and yeah, you still have the same amount of accuracy that way. Surprisingly, it's still just as accurate, but the same strategy applies. Alright, hope you guys enjoyed this video. Hope you guys liked it. Some very useful information for you guys. If you guys have any questions, just hit me up on YouTube, hit me up on Facebook, hit me up in my DMs. Yeah, love you guys. Peace out. Hope you guys have a good day. And remember, like and subscribe.